what's ahead. Leading up to the election, 52% of respondents say their strategy is rotating into cyclicals, while 26% say they'll stick with tech winners. 13% are taking some profits, and 9% are compiling cash. Joining us right now with what he's watching in the markets is Jacob Walthour. He's the co-founder of BluePrint Capital Management. What do you make of that assessment? Are you doing what the majority is doing, or are you zigzagging in another way?
Surprisingly, I'm going to be in the minority. I'm part of that 26% that continue to be big believers in tech. As you and Kramer just got finished talking about the difference between MGM, which is bricks and mortar, and DraftKings, which is not. I think that really smart investors are starting to think about how business is transacted nowadays, how they're living nowadays, and they should be building those portfolios around the things that are in their life today, right? So, for example, we have what's called a pandemic portfolio. You're assuming that most people are home most of the day. They're consuming their entertainment, and that's from home. And that should be, looking at names like Disney, Roku, Netflix, AT&T. They're doing their shopping from home. And so when we think about, e-payments, MasterCard, Visa, PayPal, we think that today's market is one that, really is not going to be driven by PE and price. It's going to be driven more by common sense, how people are living today, and how that is going to be reflected in the performance of certain companies and the lack of performance in other companies.
But Jacob, let me ask you a question. The multiples on tech stocks, as you know, have already moved. So is this about growing into the multiple? Is this about the multiple expanding even more? And what happens on the other side of a pandemic? Even though some of these trends have clearly accelerated, you have to imagine, you were talking about an MGM brick and mortar versus a DraftKings, and I get the distinction, but you have someone like a Barry Diller investing in MGM, partially because he's thinking, look, the thing's been decimated, and so even if just Vegas comes back, but the other part is, if they can capture even part of that DraftKings business, that might be meaningful.
Well, when we think about putting together portfolios, we don't think about putting together them for the next 3 months or for the next 6 months. I mean, we generally think out 3 to 5 years. And so while a lot of these tech names are expensive, we think you have to look at some of the volatility in the market as an opportunity to get access to some of those names when they trade off. And we will agree that when you look at a company like DocuSign that is far more popular today than it was pre-pandemic, and you look at the valuation of it, you look at the market cap of the company, you say the company has some growing to do to fit into that market cap. But at the same time, let's not assume that we are going back to a pre-pandemic world entirely. And a company like DocuSign may have a business model that has real relevance going forward in our economy post-pandemic.
Shepard Smith here. Thanks for watching CNBC on YouTube.